afternoon, guys.
Afternoon.
How are you, James?
Afternoon.
Good. Yourself?
Good, good, good. How about everyone else?
Hi,
Thank
good, thank you.
Good.
That sounds good. How did you guys take the news about the lockdown from last week?
Frustrating.
Yeah, well, 2 more weeks at home. Are you guys staying healthy and everything, or?
Yeah.
Sounds good. Yeah, hang in there, guys. Just 4 more weeks, and hopefully we can get out of the house doing something productive.
That's true, right?
I am aware that over the weekend and I think yesterday, there were a few emails from you guys, but I was a little bit sick last week, so I didn't really respond to my email. So after class today, I'll get back to your emails, okay? So for those of you that haven't checked yet, your results for the midterm has already been uploaded on the LMS, so you can check the results for both your Part A and Part B. With Part A, it's a multiple choice questions. You can see which questions you're right or wrong, and the solution as well. With Part B, I hope you can see the solutions for each of the questions and also the comments that I gave for your answers as well, okay? So if there's any problems at all with the marking, or if you think that you haven't been marked, feel free to let me know and I will get back to you, okay? One more issue. So someone emailed me about the assignment, and they said that in the assignment you're required to forecast exchange rate for the next 6 months. But the date on the assignment was dated in February. So for the purpose of the forecast, you can change the date to September. Okay. So I wrote the assignment back in February. So the date back then was in February, but because we are in September now, so for the purpose of the assignment, you have to do a forecast from September to March next year, okay? Okay, so any other questions before we start?
Sorry, Ran, to interrupt you, but can you please say it again, like what you just told us now about September?
Yeah.
Yeah, thanks.
So with the assignment, I think you were asked to forecast the exchange rate movements for the next 6 months, if I'm not mistaken.
Yeah.
So if that's the case, then forecast from September, which is this month, until March next year. Okay.
Right. And where we can take the historical data from, something like Yahoo Finance or something like that?
Yeah, it should be on Yahoo Finance. Yeah.
Okay.
Yeah, it should be on Yahoo Finance, so it should be okay. If there's any problem, just let me know.
Sure. Yep. Thank you.
Yeah, so it's a good time to think about starting your assignment as well, because it is due in week 11. Okay, so you have about 4 weeks to do the assignment. So for today's workshop, we are going to talk about the international parity conditions. So this is going to be our topic for this week and next week. So just a little bit of a background about this topic. So in the previous topic, we have introduced the foreign exchange market. We have talked about the spot exchange market and the forward exchange market. So the focus of this topic is on how people use macroeconomic information to forecast exchange rates. Okay. So if you recall, with the forward exchange rate, we are trying to set a rate for a future delivery, right? So if you think about a person that have to either buy or sell foreign currency forward, one of the key questions that they have to face is how much should they pay for a foreign currency, right? So for economists, they typically use macroeconomic conditions like interest rates, inflation rate, so on and so forth for forecasting, right? So in this topic, in particular this week, we are going to look at how to use interest rates to forecast forward rate, okay, to forecast exchange rates. So with the first part of the international parity conditions topic, we focus on the interest rate parity condition, which relates the interest rates between two countries and their exchange rates, okay? So the interest rate parity condition tells you what is the equilibrium relationship between interest rates and exchange rates, okay? So accordingly, the relationship between interest rates of the two countries, countries A and B in this example, and the exchange rates are given by this equation here. So if we are looking at the exchange rate between currency A and B, so if we write our exchange rate so that A is the measurement currency and B is our commodity currency, then the interest rate parity condition is provided as follows. So on the left-hand side, we've got 1 plus IA, which is 1 plus the interest rate of country A. So the country on the left will be on the left-hand side. On the right-hand side, we've got 1 plus IB, which is the interest rate in country B. So the second currency will go to the right, okay? Times the forward rate divided by the spot rate, okay? So this is the interest rate parity condition. And this is going to be the focus of our workshop today. Alternatively, you can think of these countries A and B as domestic and foreign. So if you have the exchange rate domestic over foreign, so this is a direct quote. So you can rewrite the interest rate parity as 1 plus I domestic equals to 1 plus I foreign times forward divided by spot rate, okay? So how do we prove the interest rate parity condition? We are going to prove it using arbitrage. So the basic argument here is that this equation has to hold, otherwise arbitrage activity would take place, okay? So this is a similar argument to a previous problem that we did before with the cross rate arbitrage, okay? So we're going to go through this later on. But basically, the idea is that if the equation does not hold, if this equation does not hold, then this is when arbitrage will take place. And through arbitrage activities, it will bring this equation back to equilibrium. Okay. All right. So how do we prove the interest rate parity condition? So the idea behind the interest rate parity condition is that if you have two equivalent investments, let's call this investment. So let's say if I give you $1 and I ask you to invest, I ask you to choose either to invest in Australia or in a foreign country for a 1-year horizon. You can basically construct a two equivalent 1-year investments in two countries. So in option 1, if we consider option 1, let's assume we are a US citizen. So if we get to invest $1 in either our domestic country, in this case the US, so we're assuming that we are a US citizen, or in a foreign country. So if we look at the first option, which is to invest in our domestic country, if we invest $1 today for a 1-year horizon, let's say we buy a US government bond, then in the future, in 1 year's time, we are going to get the future value of that investment, right, at the interest rate prevailing in the US, okay? So if I invest $1 today, in the future, in 1 year's time, it's going to grow to $1 times 1 plus IUS, okay? So this investment is going to be denominated in the USD because I invested in the US, okay? Now, alternatively, I could also invest in a foreign country and I will hedge my exchange rate risk so that in the end, I do not have to bear any exchange rate risk, okay? So alternatively, I could be investing in a foreign country. Let's say in this case, I want to invest in the UK, okay? So to be able to invest in the UK, I have to first exchange my USD for the pounds, okay? So for option 2 at time 0, what I will need to do is I need to convert my USD into the pound at the current spot exchange rate, okay? So let's call the spot exchange rate S. So with this exchange rate, this is the value of the pound in the USD. So if I want to convert $1 US dollars into the pound, I would take $1 US dollars, I would divide that by S, right? So here from $1 US dollars, I will convert it into, I will acquire 1 divided by S pound, okay? So if I choose to invest this much of pounds in the UK for 1 year, then in the future, after 1 year, I'm going to get the future value of this investment, okay? So from 1 divided by S pound, I'm going to get I hope you can see my writing is a little bit small. Right, so for my foreign investment, after converting the dollar into the pound and investing it for 1 year, I would expect to get 1 divided by S times 1 plus IUK in 1 year's time, okay? And because this is an investment in the pound, the future value here is going to be denominated in the pound as well, okay? So for a US investor who does not want to bear any exchange rate risk, if I know that I'm going to get this much of pound in 1 year's time, I can choose to hedge this exchange rate risk by selling the pounds forward, okay? By selling the pounds forward for 1 year, so that after 1 year, I can convert these pounds back into the dollar at a rate that I know of today, okay? So knowing that I'm going to get, let's call this FV2, just for abbreviation. So I know that in 1 year's time, I'm going to get FV2 pounds. So if I want to convert this back into the dollar and locking in an exchange rate, I'm going to be selling this much of pound forward, okay? So if I have the pounds and if I want to convert it into the USD using the forward rate, I'm going to take the pounds and I'm going to times it by the forward rate, okay? So the USD equivalent of my investment returned in the UK is going to be FV2 times F, which is the forward rate, okay? So taking everything together, given that FV2 is 1 divided by S times 1 plus IUK, I can rewrite the outcome for option 2 as this one here, okay? So 1 divided by S times 1 plus IUK times F. Okay. So if we compare the two investment options, option 1 and option 2, we will see that with option 1, we are not exposed to any exchange rate risk, right? So exchange rate risk here is basically 0 for a US investor, okay? With the second option, we invest in the UK, but then we lock in the proceeds, the USD proceeds using the forward contract. So in option 2, we also have no exchange rate risk, okay? Because we hedge the risk using the forward rate. Second, with option 1, we invest in the US government bond. So if we assume that the government does not have any credit risk, then the credit risk in option 1 would be assumed to be 0, okay? So this is government bond. In option 2, similarly, we are investing in the interest rate in the UK. Sorry, we are investing in the UK, so we're buying the government bonds in the UK, right? So if we also assume that the government, the credit risk of the UK government is practically 0, then we can safely say that for option 2, the credit risk is also close to 0, okay? So if two investments have the same risk profile, then by definition, they should have the same returns, right? Otherwise, investors will arbitrage. So given that the two investments have the same risk profiles, we expect the returns of the two investments to be the same, meaning that outcome 1, so this is outcome 1 here, should be the same as outcome 2, okay? If this is not the case, then investors will arbitrage. They will be investing more in the country where they have a higher return, and they will be shorting in the country where they have lower returns, okay? So this is the idea, or this is the argument under the interest rate parity condition. So through this exercise, we have proven that this interest rate parity condition has to hold. Otherwise, arbitrage activities would take place. Okay. Any questions so far with this analysis? So in the tutorial questions, we will have one question where we'll go through an example similar to this. Okay. So as we mentioned before, this condition has to hold for no arbitrage to take place. If it does not hold, then what would happen, right? So suppose in this case, we observe that 1 plus IS is actually less than 1 plus I UK times F minus S, okay? So the left-hand side of the equation that we saw before is actually less than the right-hand side, okay? So in this case, if we are an arbitrager, how can we take advantage of this situation? Okay. So the idea here is similar to what we discussed before about arbitrage strategies. You want to be taking two opposite positions into identical assets. Okay. Let me check my chat box. Okay. Gayatri, did you want to say something? You put a message in the chat box, but I'm not sure what you want to say.
I was just changing my name. It got sent. I'm so sorry.
Oh, okay. Right. So in this case, we are talking about two interest rate instruments. Yeah. So in the previous example, we talk about two different options where we invest into government bonds. Okay. So if we accept that the two government bonds are equivalent investment options, then when the interest rate parity condition does not hold, you want to long in one instrument and you want to short in another instrument. Okay. So from the previous slide, we know that the left-hand side is the outcome or the return of investing in the US. Okay. And the right-hand side is the return of investing in the UK after adjusting for exchange rate risk. Okay. This is very important here, guys. So a lot of times when you look at this problem, you will see that if you compare just the absolute values of the interest rates into countries, sometimes it's not the same as the interest rate parity condition. Okay. So the idea here is you can't just compare the interest rates in the two countries directly because you're not comparing apples to apples. Okay. You have to adjust for the exchange rate risk before you can compare the two countries. Okay. So if we compare the returns of investing in the US and investing in the UK, in this case, we can say that the return of investing in the US is less than the return of investing in the UK. Okay. So one way to arbitrage is therefore you can invest in the UK. You can put your money in the UK to invest because you get higher return here. And you will finance your investment by borrowing in the US. Okay. So here, as you can see, the cost of borrowing in the US is a little bit cheaper, right? Because you pay a little bit less interest rate relative to in the UK. Okay. So when the interest rate parity condition does not hold, you want to be investing in the country that you earn higher return. So in this case, the UK. And you want to be, at the same time, you want to be borrowing in the country where you have to pay a lower interest rate, right? In this case, this is the US. Okay, so in terms of arbitrage terminology, here you long in the UK and you short in the US, okay? So you borrow, that means you issue the bonds, okay? So with this arbitrage opportunity, you will be borrowing in the US. So once you get the money from the US, you're going to convert into the pounds to invest. So once you invest in the UK, you will then lock in the USD proceeds from the investment by selling the future value of the investment forward. Okay, so step one is to borrow in the country where you get a cheaper rate. Step two is to lend to the country where you get a higher rate. And step three is to hedge your exchange rate risk. Okay, so it's similar to what we did before with the previous example. So this strategy is what we call covered arbitrage. So covered means that your exchange rate risk has been covered by using the forward contract in step 3. Okay. Now, alternatively, if 1 plus IS is greater than 1 plus IUK times F divided by S, so here we reverse the order, okay? So in this case, what it means is that it is more beneficial for you to lend in the US. So invest in the US, use higher return relative to investing in the UK and hedging exchange rate risk, okay? So if this is the case, then you want to be investing in the US. So you want to lend to the US and you want to finance your lending or your investment by borrowing from the UK, okay? And hedging your exchange rate risk using the forward contract. So here you want to be lending to US and you want to be borrowing from the UK. Okay. So step 1, I'm going to finance my investment by borrowing money from the UK, where it is a little bit cheaper to do so. And then I'm going to convert the money to the US to invest, okay? Now, if I borrow, say if I borrow some pound values today, I know that in the future, I'm going to have to pay back the pounds, right? So I'm going to have to pay the future value of my pound loan. So to hedge the exchange rate risk, when I have to pay back my pound loan that I took out in step 1, I'm going to be buying the pound forward, right, for a 1-year delivery, okay? So once again, this is a covered arbitrage strategy because in this strategy, I have covered my exchange rate risk using the forward contract, okay? It will make a bit more sense later on when we go through the examples, okay? But the idea here is quite similar to before. You want to be long in one asset and you want to be short in the other asset, okay? And in this case, we are talking about interest rate instruments.
Julia,
Yes?
what in this case if the pound value increases in the future?
It will not be a worry to you because you have locked in the pound value using the forward contract. Good
Okay.
question. So if the future value of the pound increases, it will hurt your profit because you have to pay more. But in this case, because you have used the forward contract to lock in the exchange rate, then it's not a worry to you, okay? That's why it's a covered arbitrage. Good question. Okay. So we mentioned before that with the IRP, the main purpose of the interest rate parity condition is for us to work out an estimate for the exchange rate, okay? So if you think about forecasting exchange rates, the IRP provides you with a tool to do so, okay? So for example, if I start with an IRP for the USD and the pound, I forgot the brackets here, right? So if I start with the IRP equation for the dollar and the pound, if I rearrange the equation, so here I divide both sides by 1 plus IUK, and then I times both sides with S, right? So in this case, if I rearrange this equation, I will have a formula to compute the forward rate, right? So from the IRP, it gives me a tool for me to compute the fair value of the forward exchange rate. Similarly, if I want to find the fair value of the spot exchange rate, I could rearrange the equation so that the spot exchange rate is going to the left and everything else goes to the right, okay? So in that case, I would also have a formula for me to work out the fair value of the spot exchange rate. So one of the purpose of the IRP is for us to work out a forecast for the forward rate, for the exchange rate, okay? So this is quite important for exchange rate traders or anyone who has to trade in the foreign exchange rate, because typically when you trade something, you want to know the fair price of that asset, okay? And with the IRP, with the interest rate parity condition, it gives you a very straightforward and very available tool to do so, because the interest rates are normally observable, okay? So it's quite easy for you to do so. All right. Now, we could also think about the IRP. I mean, we could also check whether the IRP holds or not by comparing the forward rate that we observe in the market and the forward rate implied by the IRP, okay? So as we mentioned before, if we rearrange the IRP, we will get a formula to compute the fair value of the forward rate. So if we compare this fair value of the forward rate and the actual forward rate that we observe in the market, if they are the same, that means the IRP holds. If they are different, that means the IRP does not hold, okay? So for example, if my IRP forward rate is 1.75 and the actual forward rate I observe in the market is 1.78, okay? So in this case, the market rate is higher than the fair value. So let's call this the market rate. Okay. So if the actual forward rate in the market is a little bit higher than the fair value as implied by the forward rate, as implied by the IRP, then in this case, if you want to earn an arbitrage profit, what do you want to do, right? So do you want to be lending in the US and borrowing in the UK, or do you want to do the opposite, okay?
Maybe lending in the US and borrowing in UK?
Not exactly. So in this case, you can think of this as the market overvaluing the pounds in the forward market, okay? So this forward rate here is the value of the pound in the USD, right? So the fair value of the pound as implied by the IRP is only 1.75, whereas the market is trading at 1.78. So this implies that the pound is overvalued. So when the pound is overvalued, you want to be investing in the UK because you will earn a higher return there, right? Because their currency is overvalued. And in contrast, you want to be borrowing in the US, okay? So when one asset is overvalued, you want to be selling or lending to that asset, okay? So here you want to lend, and here you want to borrow. So to check if our logic is correct, what we can do is we can go back to our equilibrium equation and we rearrange it, okay? So for example, in this case, what I've got is, I've got the forward rate being greater than the implied forward rate given by this equation here. So what that means is that if I rearrange, right? So I take S to the left-hand side and 1 plus I UK to the left-hand side. I will find that it will be greater than 1 plus I US, okay? So in this case, when F is greater than the fair value under the IRP, when I go back to check my IRP condition, I will find that this is the case, okay? So this implies that I should be investing in the UK and I should be borrowing in the US. Similarly for the second condition, so in this case, the market is trading the forward exchange rate, the forward rate at 1.7, so $1.7 per pound. But we know that the fair value of the forward rate should be 1.75, okay? So the market is undervaluing the pound.
Yeah, we will borrow the UK pounds and, you know, lead
Exactly.
it to the US dollars, lend it to
Exactly.
the US dollars. Yeah.
So here you want to borrow the undervalued asset and you want to be lending the overvalued asset, okay?
Excuse me, ma'am.
Yes.
Can I please know what do you exactly mean by the fair value?
Fair value is like the forecast value that you get from this equation here. So this is the IRP condition. And according to this IRP condition, this is how much the forward rate should be. So this is what we mean by the fair value. Does that make sense? So it's a theoretical value of the forward rate that is
Okay,
implied
so
by.
the fair value and the forward rate both are different. Is it
No,
right?
no. You mean this value and this value?
Yeah.
Yeah, so this is the market, the actual rate that is traded in the market. And this is only a theoretical rate. So this is what we think is right, but this is the actual rate that is traded.
Yeah.
Yeah.
We are just estimating that fair value.
Exactly, yes.
Thank you.
So sometimes the market rate might not be the same as the fair value. All right, so one point to note is that in this analysis that we have done so far, we have assumed that we have made a few important assumptions. So the first one is you can easily borrow and lend in 2 different countries without any restrictions. And second, you can borrow and lend at the same rate, okay? So for example, if I borrow in the in the UK, sorry, I'll be borrowing at IUK. Alternatively, if I want to lend in the UK, I will get the same rate, IUK as well, okay? So there's no transaction cost at all for me to lend or borrow. So in practice, there have been a few papers in the past that look at whether the IRP holds or not. So the idea here is that if the IRP holds, you should see that the forward rate is around the level implied by the IRP, right? So in some studies in the past, people have compared the forward rate actually in the market and the IRP rate, right? So in overall, the findings have been a little bit mixed. So in the past, people have found that sometimes the IRP does not hold, but some other times the IRP holds, okay? So some possible reasons for why the IRP might not hold in practice is, firstly, if the government imposes some control on capital flows that prevents people from borrow or lend, then it will prevent arbitrage activities, right? So without arbitrage activities, the IRP condition might be out of equilibrium, okay? So you need arbitrage to allow people to adjust for different prices. Secondly, due to transaction costs, sometimes arbitrage activities are not profitable, and as a result, it also discourages arbitrage activities, okay? Making the IRP going out of equilibrium, if you like. Nevertheless, overall, it is a good indication of where the forward exchange rate should be, given the current interest rates and the spot exchange rates, okay? So sometimes we also write the IRP in approximation, right? So this is our proper IRP, and sometimes we write them in approximation. So the purpose of having an approximation is that it is more straightforward to use. So for example, here, if I know that the interest rate in the US is greater than the interest rate in the UK, so that IS minus IUK is greater than 0, then I know that the forward rate should be greater than the spot exchange rate, okay? So in this case, the approximation gives me an easy, give me a quicker estimation of where the future looks like, okay? So when the interest rate in the US is greater than in the UK, then the pound is expected to appreciate in the future, okay? So the forward rate is greater than the spot rate. Also, I can approximate the forward discount or premium using the difference between the interest rates, okay? So what this equation means is that the forward premium is about the size of the difference between the two interest rates, okay? So this is your forward premium or discount.
Excuse me, now.
Yeah, sure.
Can you please explain me the approximated format again?
Yeah, sure. So with this proper IRP, it's a little bit hard to use, right? So if you want to say, if you want to approximate the forward discount or premium, it's a bit harder to see from this IRP equation. But from the approximation, you can pretty much guess how much the forward discount or premium should be, okay? So for example, in this case, let's say the difference between the interest rate in the US and the UK is, say, 2%, okay? I'm just making this number up. So if the interest rate in the US is 2% higher than the interest rate in the UK, then I can safely say that the forward discount or premium, in this case a premium, so the forward premium in this case will approximate about 2% as well, okay? That's because F minus S divided by S is my forward premium, okay? Also, F and S here is the value of the pound in the USD. So here, based on the approximation, I can tell easily that in the future, the pound is expected to appreciate, okay, by about 2%.
Why should it appreciate?
That's because the difference here is positive. Does that make sense? So in this example, I assume that the difference between the interest rate in the US and the UK is 2%, which means that the forward premium here is about 2%. Okay.
So we're thinking that the dollar interest rate is higher than the pound interest rate.
Mm-hmm.
So how come the GBP is increasing here, ma'am?
Yeah, because by this equation, okay, let me rewrite. So here, so if I assume that the interest rate in the US is going to be 2% higher than the interest rate in the UK, right? Oopsie. Right, so if the left-hand side is 2%, that means the right-hand side will be approximately 2% as well, right? So because this is a positive number, that means the future, the forward exchange rate should be greater than the spot exchange rate, okay? And the ratio of the change, the ratio of the difference should be about 2%, meaning that the pound is expected to appreciate by about 2%, okay? So this exchange rate here is the dollar over the pound, meaning that this is the value of the pound, okay? Does that make sense?
Yeah, ma'am, pretty much. Thanks.
Okay.
So we are looking from the perspective of the US investors in the fair, right?
In this case, not necessarily. I'm just looking at, so I'm looking from the perspective of the value of the pound.
Okay.
Yeah.
Yep. Thanks, ma'am.
All right. So we spend a lot of time talking about the covered interest rate parity, or covered interest rate arbitrage. Now, we mentioned before that this is covered because through the arbitrage strategy, we have locked in, we have hedged our exchange rate risk using the forward contract, right? So when we constructed the arbitrage strategy like we did before, we borrow in one country and we lend to the other country. Along the way, we fix or we hedge the exchange rate risk by either selling or buying the foreign currency forward, okay? So with the covered interest rate arbitrage, you basically know for sure how much your inputs will be like. So you know for sure what the interest rates in the two countries are. You know for sure what is the spot rate, and you know for sure what is the forward rate, okay? So in this strategy, you are not exposed to any exchange rate risk here. So exchange rate risk is eliminated. Now, with the uncovered interest rate arbitrage, this is a different story, right? So in this case, you follow the same steps as we talked about before. If you think that the interest rate in one country is cheaper relative to another country, then you want to be lending or borrowing accordingly, right? But instead of fixing your future foreign currency using the forward contract, you will leave that position open, okay? So in this case, you don't lock in your exchange rate. You don't hedge your exchange rate risk. And as a result, your future investment returns or your arbitrage returns depends on the value of the future exchange rate risk, the future exchange rate. Okay. So in this case, if the future exchange rate moves in your favor, you will earn a profit. But if it moves against you, you're going to lose money. Okay. Now, the idea of an uncovered interest rate arbitrage is that if the forward rate is an unbiased predictor of the future, then the expected future exchange rate should be the same as the forward rate. So in the future, if nothing changes, then it is not necessary for you to hedge exchange rate risk because the future exchange rate is going to move towards the forward rate anyway. Okay. So an uncovered interest rate arbitrage will give you the same result as a covered interest rate arbitrage if the future exchange rate is going to be the same as the forward rate. Okay. So this is based on the idea that the forward rate should reflect the expected future spot rate. Okay. So if nothing changes from now until then, the expected future spot rate should be the same as the forward rate. Of course, in practice, things might change along the way, and that means your future exchange rate might not be the same as the forward rate. Okay, which means the uncovered interest rate parity is a little bit riskier. Okay. All right, so we have gone through the main points for the first part of interest rate parity conditions. So as we mentioned before, with the first part, we focus on just the interest rate parity conditions, okay? And this is the most important parity condition for the purpose of exchange rate determination, okay? One reason is because interest rates are easily observable, so you can easily forecast your exchange rate using the interest rates. Okay. So in the next few hours, in the next 2 hours, we are going to go through some tutorial questions as before. With the theory questions, these are the theory questions. And with the practice questions, we've got 4 different practice problems, okay? So let's take a short break of 5 minutes and we will come back at 3 p.m. and then we will go through the tutorial questions together, okay? I will see you guys. Yes.
No worries.
I'll see you guys back in 5 minutes. Okay. Let's go through our theory questions first. So with the theory questions, they are quite straightforward this time, I think, because at least some of the questions we have talked about in the previous topic. For example, with question 1, define arbitrage, right? So this is what we have talked about extensively with the cross-rate arbitrage. So for an arbitrage strategy, this is the act of simultaneously buying and selling the same or equivalent assets, right, for the purpose of making certain guaranteed profits, okay? So in other words, you want to be taking a long and a short position into identical assets, right? So you take 2 opposite positions into identical assets. Ideally, they are priced differently into different markets, and that will enable you to earn the profit, which is the spread in between. Sorry. So the idea here is always to buy low and to sell high so that you can earn the spread, okay, in between. Now, for an arbitrage strategy, if you have a purely arbitrage strategy, then your position should always offset each other. So your buy position will offset your sell position so that you are not exposed to any risk, okay? So the arbitrage strategy should earn you a profit from the difference in the prices of the asset in two different markets. And as a result, you should not bear any risk, okay? This is a zero cost strategy as well, which means that all transactions finance themselves, okay? So for example, here, your buy transaction, so when you buy something, you have to pay money for it. So here, your buy transaction would involve a cash outflow, and this cash outflow will be financed by your sell transaction here, okay? So when you sell something, you get paid money. You will use that money to finance your purchase here, okay? So this is a zero risk, zero cost strategy, and the profit will therefore come from the difference in the prices of the asset or the mispricing itself. Okay. One thing to note is that arbitrage is not hedging. Okay. So if the question is talking about constructing an arbitrage strategy, then don't think about hedging. Okay. So the key distinction between the two is that when you arbitrage, your end goal is you want to earn a profit. Okay. So you want to identify a mispricing and you want to make profit from that mispricing. When you hedge, this is when you try to manage your risk exposure. So your end goal here is you want to minimize your risk exposure. Okay. So the goal is to either have zero exposure or to minimize it. Okay. All right. Question 2. The implications of the IRP for the exchange rate determination. Okay, so what does the IRP mean in the context of exchange rate determination? So we mentioned before that the IRP allows us, so it gives us a tool to help us compute a fair value of the exchange rate. Okay, so in this case, if I want to compute the fair value of the spot exchange rate, I can rearrange the IRP so that the spot exchange rate is on the left-hand side and everything else is on the right-hand side. Okay, so what I did here was I take the spot exchange rate to the left, and then I take 1 plus IA to the right. So if I rearrange the IRP so that it gives me a formula to compute the spot exchange rate, then what this means is that it implies that the exchange rate, the spot exchange rate, could be computed by 3 inputs. So number 1, if I have the interest rate in country A. Number 2, if I have the interest rate in country B. And number 3, if I have the forward rate readily observable. Then with these inputs, I can compute a fair value of the spot exchange rate, okay, following this equation here. So this is similar to what we talked about before. Question 3, explain the conditions under which the forward exchange rate will be an unbiased predictor of the future spot exchange rate. Okay. So we mentioned before a couple of times that normally people use the forward rate as a forecast for the future exchange rate. Okay. So for the forward rate to be an unbiased predictor of the future spot exchange rate, we need 2 conditions to hold. Okay. Now, number 1, in this equation, if we express the forward rate as the conditional expectation of the future spot exchange rate, what we are ignoring here is that we are ignoring the forward risk premium, right? Or the risk premium on the forward contract. Now, what does it mean by forward risk premium? So when we buy a forward contract, we are exposed to counterparty credit risk, right? So if I go to CBA and I buy a forward contract from them, there is a chance that in the future they might default on my contract. Okay, so when I enter into a forward contract, inherently I will be bearing the risk of the counterparty. Okay, so in this formula here, we basically ignore that element. Okay, so here we are assuming that credit risk does not exist, or it's very close to zero. Okay. Now, why can we assume that this is the case? Okay, so is this a reasonable assumption to make? So in the forward contract, you will be trading with the banks most of the time, right? The forward contract is an over-the-counter contract, so most of the time you'll be trading with a dealer, who are normally a big financial institution. So for these institutions, the credit risk premium is quite low given their size and their reputation. Okay, so as a result, with the forward rate, you can assume that the forward risk premium is not too noticeable. Okay, so as a result, you can safely ignore this credit risk component. Second, for the forward rate to be an unbiased predictor of the future spot exchange rate, you need the market to be informed, right? You need the market to be rationally informed. So in other words, you need the market to be able to have enough information to form an expectation about the future. Okay, so if the information set, so if we look at this formula here, so here what it says is that the forward contract, the forward rate is basically a conditional expectation of the future spot exchange rate, right? So this is the expected future spot exchange rate conditioned on the information set that investors have as of today. So for this to be unbiased, you need this to be correct, okay? So the investors have to have enough information to make a forecast of the future exchange rate, okay? All right, so these are all the theory questions for today, which I think is not quite tricky. Any questions so far with the theory, or are we happy to move on to the problems?
Happy to go on for me.
Okay, thanks, James. So I'm going to assume that everyone else is okay as well, if I don't hear anything. So let's move on to the numerical problems then. So for problem 1 from the textbook, this is actually covered in the lecture slides, but I just want to go through it in class as well to make sure that we understand, okay? So this is an illustration of the analysis that we did at the start of the workshop. So in this case, we have a treasurer of a US company, and they want to invest for 6 months, okay? So they want to invest 100 million for 6 months. So they observe that the interest rate in the US is 8% per year, and the interest rate in Germany is 7% per year. They also observe that the current spot rate is 1.01 euro per dollar, and the 6-month forward rate is 0.99 euro per dollar. Okay, so in this case, my exchange rate is like this. So this is the value of the dollar in the euro. We do not want to bear any exchange rate risk, meaning that if we invest overseas, we need to remember to hedge out exchange rate risk using the forward contract. The question here is, where should we invest to maximize the returns? Okay, so here we've got two options. Either we would invest in the US or we would invest in Germany. Okay, sorry. So in the next few minutes, let's talk through the investment returns of these options and compare these returns to make a decision. Okay. So I'm going to start a whiteboard. And we can go through the questions together. Okay. So I have the question here on the whiteboard. So here I want you to think about computing the investment return for two options. Option one is to invest domestically, meaning that we will invest in the US, given that we are a US company, right? And option two, we will invest in Germany, which is a foreign investment, okay? So I suppose that for both options, we are going to start with 100 million USD. So what I want to know is what would be the investment returns for each of these options, okay? And remember, if we invest overseas, we need to hedge exchange rate risk, okay? So here, if my investment horizon is only 6 months, the first thing you need to do is you need to convert the annual rate into a 6-month rate, okay? So here my IUS is going to be 4% for 6 months. And the I Germany is going to be 3.5. So I'm going to start with option 1, and you guys can help me with option 2, okay?
Sorry, Ran, I just have a question.
Sure, Anish.
Why have we taken IUS equal to 4%?
That's because we're looking at the 6 months horizon.
Also, this sorry, this is per annum. Sorry. Yeah,
Yeah.
my mistake.
So here we want to invest only for 6 months.
Right. Yes. Sorry.
It's okay. So here, if I invest today in option 1 in the US, in the future, I'm going to get the future value of my investment. Okay. I'm going to shut up for now so that you guys can have some quiet time to do option 2. And I will write the answer for option 1 on the whiteboard. Okay, guys. So if I want to invest overseas, what is the first thing I need to do?
Swap currencies.
Exactly, spot on. So I want to convert into the foreign currency first. So my first step is I want to convert the dollar into the euro. Okay. Because I converted at the current time, I'll be going to the spot market and convert at the spot exchange rate. So from 100 million, I'm going to times it by the exchange rate, and I'm going to get 101 million euro. Okay, spot on. Now, what do I need to do next? Once I got the euro,
Invest in euro 3.5.
exactly, spot on. So I want to be investing in the euro in Germany and earned 3.5% for 6 months. Which means that in the future, in 6 months' time, I expect to receive. Which is how much? Okay. So in 6 months' time, this is how much I expect to receive from my euro investment. Now, because I do not want to bear any exchange rate risk, I need to hedge. I need to lock in the conversion rate for the euro using the forward contract, right? So in this case, do I want to be selling or do I want to be buying the euro forward?
I think buying.
So you expect to receive this much euro in the future, and you
Yeah.
want to convert it into the USD.
Yes.
So
would that be a buy or a sell?
selling to acquire
The future, yeah, they sell the euros into USD.
Exactly, yes. So here you expect to receive a positive euro inflow, a euro cash inflow, and you want to convert it into the USD, right? So in this case, in the forward market, you want to be selling your euro to acquire the USD, okay? Does that make sense, Anish?
Yeah. Yeah.
Okay.
So it's like I just thought like if it is going to be like in the forward exchange rate 0.99 per euro, so I just thought like we'll buy at that time because it's going low and yeah, something like that.
So here I decide to buy or sell depending on my euro position, not
Mhm.
on the different prices of the forward exchange rate.
Okay. Okay. Yeah.
Yeah.
Sure. Yeah. Thanks.
So here your decision is to hedge exchange rate risk. Okay.
Right. Right.
Yeah.
Yep. Thank you.
So with the interest rate parity condition, the arbitrage that you do is on the interest rate instruments, and the exchange rates are used to hedge exchange rate risk. Okay, so you don't arbitrage on the exchange rate contracts. You arbitrage on the interest rate instruments. So in step 3, you want to convert the euro proceeds back into the USD by selling the future value forward. Let me write 6 months forward to be clear, at the forward rate of 0.99 euro per dollar. Okay, so from 104.535 million euro, you want to convert it into the USD, right? Given that this exchange rate is the value of the dollar per euro, you want to take your euro proceeds, you divide it by the exchange rate, okay? So that will give you 105 million.
Yeah. 105.555.
I've got 59 something.
Yeah. It's
Yeah,
coming.
5909091.
Yeah. Is that what you said, Anish?
No, there's something else. I told. Oh, it's 104.535, right?
Yeah.
Oh, sorry.
Divided by.
I just took 104.5. Sorry.
Yeah, that's okay. Million? Okay. So with option 2, through step 3, we have eliminated any exchange rate risk here. So with option 2, we have 0 exchange rate risk as well. Okay. So in this case, if we compare option 1 and option 2, which option would we choose?
2.
2.
2, yeah.
Option 2, yes, exactly. So with option 2, you get a higher proceeds. Okay. Let me save this screen. So we have gone through the exercise for problem 1. Let me just share the notes with you guys in the chat box so you can have something to revise later on. Let me see if I can share it here. Okay, that is done. So we have gone through problem 1. So similar to before, I'm just showing you the answer in the PowerPoint slides, but it should be the same as what we went through in the whiteboard. Now, so in problem 1, we have looked at a case where we have 2 investment options, okay? In problem 2, it's similar to problem 1. The only difference is we are looking at the payment, okay? So here you have 2 options for payment instead of investment. So in problem 2, you are visiting London and you purchase a Jaguar for £35,000. And once again, we assume that we are US citizens. This money is payable in 3 months' time. You've got enough cash at your bank in New York City, which pays 0.35% interest per month, compounded monthly, to pay for the car. The current spot exchange is $1.45 per pound, and the 3-month forward exchange rate is $1.4 per pound. In London, the money market interest rate is 2% for a 3-month investment. So you have 2 options to pay for your car. You could either keep your money in the bank in the US and you buy the dollar forward, you buy the pounds forward, so that in the future, in 3 months' time, you just take the pound and deliver to your car dealer. Okay. With the second option, you want to buy a certain pound amount today and invest the amount in the UK for 3 months so that the maturity value is equal to £35,000. So you have enough money to pay your car dealer in this case as well. The problem here is to evaluate each option and choose which option you prefer. Okay. So in the case of payments, do you prefer a higher value or do you prefer a lower value?
Pay a lower value for a car.
Exactly right. So you want to pay less. So you want the option with a lower value. Okay. So similar to before, I'm just going to share a whiteboard and we can solve the problem together. Okay. Let me clear all drawings. So this is a summary of the question. Right, so your foreign currency obligation is £35,000. You pay in 3 months' time. These are the interest rates in the 2 relevant countries. These are the spot and the forward exchange rates. I'm just going to write option A and B so that it's clear. Okay, so did anyone want to go through option A for me? So essentially with option A, you basically keep your money in the bank and earn the US interest rates for the next 3 months. So, and then in 3 months time, you're going to settle your forward contract, exchanging the USD for the pounds, okay? So with option 1, could you help me compute the cost of option 1? James?
Yeah, I think I can have a go.
Yeah, sure.
So we have the £35,000. We start with, and what do we need to do? Oh, we need to buy the forward 3 months at the rate of $1.40 over £1.
Exactly, yes.
And that gives you 49,000 USD.
Yes, exactly. So let me write down the transaction here. So for £35,000, you need to pay 49,000 USD, right? So let me write it down here. So you take £35,000 and you times it by the forward rate, right? Okay.
Yeah, and then, like you said, then you just take that 49,000 and you invest it in the 0.35% per month. So it's 49,000 divided by 1.0035 to the power of 3.
Exactly, spot on. So this is the future value of your, this is the value that you have to convert into the pounds in 3 months' time. So this is the future value, right? So if you want to find the present value of that USD proceeds, you need to take the future value and you divide it by 1 plus interest rate per month to the power of 3 for 3 months. Okay, so that means 49,000 divided by 1.0035 to the power of 3. Can you tell me how much that is?
48,489.
Exactly, yes. So 48,489. Okay. So this would be the USD costs for option A. Okay, spot on, James. What about option 2? So here, instead of keeping your money in the US bank, you convert it into the pounds first, then you deposit it in a certain UK bank to earn 2% for 3 months. You set up your investment in the UK so that the future value is going to be £35,000. Okay. So for this option, therefore, if I want to compute the USD cost of this option, what would that be? So similar to before, I want to work backwards, right? So here from the future value, which is £35,000, I'm going to find the present value in the pound, okay? Given that the interest rate in the UK is 2% for 3 months, this will be a simple calculation, okay? So I'm going to take the future value, £35,000. I'm going to divide it by 1 plus R, which is 1.02. Okay. So this will give me 34,000 and 313. Okay. I'm just going to put 3 decimal places. Okay. So this is done. I'm going to now work backwards to find how much USD I have to pay to acquire this much of pounds. Okay. So if I want to find the USD equivalent of 34,313 pounds at the spot rate, I'm going to take 34,313 times 1.45. Okay. So that will give me 49,754. Okay. So one important thing to note here is that when you compute, when you compare the cost of 2 different options, you need to make sure that you compare them at the same point in time. Okay. So for example, in this case, in option A, I have computed the value of the USD obligation as of time 0. And in option B, I have also done the same thing. Okay, so these 2 values are as of time 0, which means I can compare them directly. Okay. So given the 2 numbers that we have just computed, which one would you prefer, option A or B?
The cheaper one, so A.
Exactly, spot on. So you want the cheaper option, okay? You want this option here. All right, guys, well done. Now I'm just going to share the notes with you, and then we can move on to the next question. Okay. So these problems are very similar to the previous analysis that we did in the start of the workshop. So with these problems, they help you understand the setting in which we set up the IRP condition, okay? So basically you wanna compare 2 equivalent options, and if they are the same, then your IRP condition will hold. If they are different, this is when your IRP does not hold, okay? And this is when, as an arbitrager, you can choose where to invest and where to lend, okay? So if you want the answer in words, here they are. They should be the same as what I showed you before anyway. Yeah, so if you want to take a screenshot of this slide, you're welcome to. And then we can move on to the next question, okay? Okay, problem 3, this is when we conduct an IRP arbitrage, okay? So in the previous 2 questions, we are just looking at comparing different options. In this problem and problem 4, we are going to use arbitrage based on the IRP condition. So in this case, we've got all the information we need. We've got the spot exchange rate. We've got the forward rate. We have the interest rates in the 2 relevant countries as well, okay? Now, with IRP arbitrage, it's very important to get the IRP equation right. So to get that right, you need to start with the correct exchange rates, okay? in this case, your exchange rate is the USD over pound, meaning that this is the value of the pound in the USD. Okay. So given that this is the exchange rate that we start with, our IRP should be written as 1 plus I US. So the left-hand side currency should go to the left-hand side. Then on the right-hand side, you've got 1 plus I UK. So the second currency goes to the right. Times forward divided by spot. Okay. Also, these are the per annum interest rates. So if you have a 3-month horizon, you need to adjust it for the time horizon, okay, by dividing it by 4. The question here are, firstly, determine whether the interest rate parity condition holds, meaning does this equation hold, okay? Question B, if the IRP is not holding, how would you carry out covered interest rate arbitrage? When you see the word covered, you know that you are dealing with a strategy that involves the forward contract, okay? Show all the steps and determine the arbitrage profit. Finally, explain how the IRP would be restored as a result of covered arbitrage activities. So similar to before, I'm going to share a whiteboard. Sorry. So here are the important pieces of information. So you would have noticed that I have adjusted the interest rates for the 3-month time horizon, okay? So this is 8 divided by 4, and this is 5.08, 5.8, sorry, divided by 4, okay? So this is 352. Let's take a short break of 5 minutes, and also in the meantime, think about this problem. Let's come back at 4, and then we can go through the problem together. Okay, so I'll see you guys at 4 p.m.
Okay.
Okay, guys, let's come back to our tutorial question. So in this case, you want to be checking the IRP first. So similar to our cross-rate arbitrage before, you want to check whether there is any arbitrage condition, okay? So in this case, it will be the IRP. So in question 1, therefore, I'm going to start with an IRP equation, which I wrote on the whiteboard here. So if I put in the number for the left-hand side, what do I have here? 1.02, right? For the right-hand side, if I plug in the numbers, this is what I'm going to have. So 1.045, 145. Anupam has a question about the assessment. So the question is, how do I know if I have to solve the assignment regarding the even or odd number? So the answer is you have to look at your student ID. If your student ID is an odd number, then you do version 1. If your student ID is an even number, then you do version 2. Okay. So where were we? We are here. So I want to times it by the forward divided by the spot rate. So that would be 1.52 divided by 1.5. Okay. So here my right hand side is going to be 1.028. Okay. So if I compare the left hand side and the right hand side, I can see that in this case the IRP does not strictly hold. So the left hand side is a little bit less than the right hand side, right? So this is currently where I am. So the answer to question 1 is therefore the IRP is not holding. Okay. Following on from question 1, in question 2, given what we computed for question 1, how would we devise an arbitrage strategy, a covered arbitrage strategy? In this case, where do you want to lend and where do you want to borrow?
You can short from USD or borrow from USD and lend in UK.
Exactly, spot on. So here it looks like the investment return in the US is less than the UK after adjusting for exchange rate risk. So for an arbitrage job, I want to be lending or investing in the UK. And I will finance my lending by borrowing from the US. Okay. So here I lend or I invest in UK. Then I borrow in the US. More importantly, I will need to hedge my foreign exchange rate risk using the forward contract. Okay. So once we have listed out what we need to do for our arbitrage strategy, can we put it in the numbers? So here we can start with either borrowing $1.5 million or 1 million pounds. Okay. In this case, because I'm borrowing in the US, I'm going to be borrowing $1.5 million. Okay. So 2 by 1. Hang on. So if I borrow in the US, the interest rate I'm looking at is 2%. Okay. So if we borrow, we know that in 3 months' time we need to pay back. Okay. So the future value of our loan would be the future value of 1.5 million. Okay. So payback an amount of 1.5 million times 1 plus the interest rate, which is 2%, in 3 months' time. Okay. So if you have computed the amount of the future value, can you tell me what it is? How much do I have to pay back in 3 months' time?
$1,530,000.
Exactly, spot on. So this is how much I need to pay back on my loan, on my US loan, okay, in 3 months' time. So following on, so from 1.5 million that I borrow in step 1, I would then convert it into the pounds so that I can lend in the UK. Okay. So here I'm going to have to convert 1.5 million USD that I just borrow into the pounds at the spot rate. Okay. So at the current spot rate, how much pounds do I get? So if I take 1.5 million and I divide it by 1.5, that will give me 1 million pounds. Okay. So using the pounds I just acquired, I am going to invest in the UK for 3 months. Okay. So here I'm going to invest in the UK for 3 months. Which means in 3 months' time, I expect to receive
1,014,500 pounds.
exactly, yes, spot on. So here I'm going to times it by 1 plus the interest rate in the UK, which is 0.0145. So that will give me 1,400,500 pounds. Okay, so we have done the borrowing and we have done the lending. Our final step is to hedge our exchange rate risk, okay, using the forward rate. So in this case, as a US investor, my exchange rate risk is in the pound, okay? So to hedge this risk, I want to be converting the pounds that I receive in 3 months' time back into the dollars using the forward contract, okay? So I'm going to hedge the investment return that I expect in the next 3 months in step 2.3. So given step 2.3, given that I expect to receive 1.0145 million pounds in the future, if I want to hedge this exchange rate risk, do I buy or do I sell the pounds?
You sell the pounds?
Exactly, spot on. So you want to convert it back into the USD. So you sell the pounds to get the USD, all right? Forward. Just going to say 3 months forward to be clear. So in that case, the expected USD proceeds is going to be
$1,542,040.
exactly spot on. So here, I want to take these pounds and I'm going to times it by the forward rate, 1.52. So the final answer is $1,542,040. Okay. So to compute the arbitrage profit, it will be just a straightforward calculation. We will take the proceeds from step 4 and we minus the initial borrowing. We minus how much we pay back to our lenders. which is the future value that we computed in step 1. So here I'm going to take $1,542,040. I minus it with the amount that we have to pay back our lender, which is 1,530,000, and that will be $12,040. Okay. So just be careful here. You've got to deduct the amount that you have to pay back. Okay, not the initial borrowing amount. Any questions so far? Sorry, with the IRP arbitrage? So one thing to note here is that, as we mentioned before, you cannot simply just compare the two interest rates in the US and the UK, okay? Because you're not comparing apple and apple. By comparing the absolute value of the interest rates, you're assuming that the exchange rate risk does not exist, okay, which is not correct. So for a reasonable comparison, you need to compare the interest rate after you adjust for exchange rate risk, okay? So we have done question 2. With question 3, how would the IRP be restored as a result of covered arbitrage? In other words, if everyone follows the same steps that we have just done before in question 2, then what would happen to the IRP? So currently this is where we are. So there is a disequilibrium. So if all investors, if everyone is smart and rational and everyone identified the same arbitrage opportunity, everyone will be lending in the UK and borrowing in the US, right? So how would that affect the interest rates in the US and in the UK? If I have more lender in the UK, what would happen to the interest rates?
Decrease.
Decrease, right? Spot on. So when there is more supply, the interest rate should decrease. Okay. Similarly for the US, if I have more borrowers, there will be more demand for money, and so the interest rate in the US will increase. Okay. Also, at the same time, because I'm selling the pounds forward, so if everyone keeps selling the pounds forward, it will decrease the forward rate. Okay, so more supply, lower exchange rate. Similarly, in step 2.2, if everyone sells the USD to buy the pounds, right? So in step 2.2, you sell the USD and you buy the pounds. That will increase the spot exchange rates. Okay, so in step 2.2, you convert the exchange, the currencies in the spot market. Okay, so the overall effect is that it is going to increase the value of the left-hand side and decrease the value of the right-hand side. Okay. meaning overall. So we are currently here. The left-hand side is a bit greater than the right-hand side. Eventually, through arbitrage, it will bring the two sides to equal. Okay, so it brings the equation back to equilibrium. So over time, this will bring the IRP back to equilibrium. Okay. I think I missed an L, yeah. All right, so are we all clear with question 3?
So after all, our profits, how much?
$12,040.
So if we simply invest in USA, it would be 1.5 and 30,000.
Exactly.
Yeah, we'll be better off.
No, if you invest in the US, you get this much. If you invest in the UK, you get this much. Does that make sense? That's why you've got a bit of profit here.
So 12,000 is the overall profit.
Yeah, for the arbitrage strategy.
So, but if we simply invested in 3 months, it would be $1,530,000. So it would be $30 as a profit, $30,000 as a profit.
So if you look at 2 investment options,
yeah, just
right.
the first step. Have a look at the first step in 2.1. So that's $1,530,000.
Exactly. So yeah, so if you just invest in the US, you will get but that means you have to invest 1.5 million. So number one, you have to commit 1.5 million to get that 1.530. And number two, if you have the choice to invest 1.5 million, you can choose to invest in the UK to earn a little bit higher profit, okay? Which is here in step 2.4.
Anyways, we're converting 1.5 million to pound.
Yeah, but you would do that because you would earn a higher profit in the end. Does that make sense?
Because I'm comparing 12,000 with 30,000.
Yeah, I understand. I'm trying to explain. So the
but
12.
You're saying that's the last profit, final profit, 12,000.
Yeah, from the arbitrage.
But on the other hand, the simple invest in USD would be 1,530,000. So that's 30,000 as a profit after 3 months.
Yeah, so you're correct. Now, there is a key difference between what I'm talking about here and your profit. So with the strategy that you talked about before, this is not an arbitrage profit, right? So you have to commit 1.5 million investing in the US for 3 months to earn that 1.53 million USD. So that investment incurs some costs and it incurs some risk as well. Whereas for this strategy that we just talked about, this is an arbitrage strategy. If you look at all the transactions here, you will find that this strategy does not require any initial investment. And yet we still earn $12,040.
All right, yeah.
Yeah.
Not initial. We don't have to deposit it for 3 months.
No, yeah.
All right.
Yeah, very good question. So yeah, so just be careful about that. So with arbitrage strategy, you don't have to commit anything. Okay, where were we? What do I want to talk about? Right, so we have finished problem 3. Let me save and let me share the notes with you guys before we move on to the next one. Okay, good question, Nekis. Now, if we have understood problem 3, then problem 4 will be quite easy for us. It's basically a similar sort of calculation with a little bit of twist, okay? So this is problem 4. So similar to before, we've got a IRP arbitrage problem. We've got the spot rates, we've got the forward exchange rate, we've got the 2 interest rates in the UK and in France, in the US, sorry, and in France. Question 1, how do we earn a certain profit via covered interest rate arbitrage? And the profit is in terms of the USD, right? Question 2, same issue, but instead of realizing profit in the USD, we want to realize profits in the euro, okay? So with question 1, we are a US citizen, and in question 2, we are a French citizen, okay? So with the 2 questions here, the same logic would apply. The only difference is when we convert the currencies using the forward rate, okay? So I'm going to start a whiteboard. I'm going to put the information in here. So similar to what we did before, we want to start with the IRP equation, okay? So in this case, my exchange rate is the euro over the USD. So on the left-hand side, I've got the euro. On the right-hand side, I've got the USD. So when I write my IRP condition, it looks like this. So 1 plus interest rate in front equals to, so the left-hand side currency goes here, equals to 1 plus interest rate US times F divided by S. Okay, interest rate US goes here. So you want to first check your IRP condition, okay? Okay, so in this case, how do I take advantage of an arbitrage strategy? I've got 3 answers so far. I've got 4. got 6 people answering. So if you have already determined the strategy, can you help me compute the arbitrage profits? I'm just going to wait for other people to answer. So I've got 12 answers now, and I'm just waiting for another 12 or so. Okay, right, so now we've got 4 people choosing the right answer. So in this case, what you want to do is you want to be borrowing where it's cheaper to do so. So it looks to me like it's cheaper to borrow in the US and it's more expensive in the UK, I mean in France, okay? So as a result, I want to be lending in France and I want to be borrowing in the US, okay? So I'm going to just set up the steps for the IRB arbitrage, assuming that we want to earn profit in the USD, okay? So here I want to be borrowing in step 1. According to this equation, I will be borrowing in the US, okay? How much can I borrow? I can borrow 1 million USD. Okay. I want to borrow for a period of 3 months. That means in the future, I expect to pay 1 million times 1 plus 1.4%. In step 2, I'm going to convert the USD to the euro so I can invest in France. So I'm converting 1 million USD, which is how much I borrow, to euro. So at the current exchange rate, 1 million USD is equivalent to 800 euros. Okay, so I get 800,000 euro. Step 3. So once I've got the euro proceeds from step 2, I'm going to use that to invest in France, okay, to earn an interest rate of 1.35%. So invest in France. Earned a future value of 800,000 times 1 plus 1.35 euro, okay? Now, if I want to hedge my exchange rate risk, meaning that I want to make sure that I can convert back into the USD at a certain rate that I know today, then what I want to do is I want to be selling the francs I want to be selling the euro that I expect to earn in 3 months' time into the USD using the forward contract. Okay. So step 4, I will be selling the future value of the euro investment. Forward. Okay. Finally, to compute profit, I'm going to take how much I earned from my investment in franc, convert it back into the USD, and minus the borrowing cost from step 1. Okay. So profit. So if you have done this question already, can you help me with the numbers here for the calculation? So I need the future value for the borrowing in step 1. I need this future value too. And then I need the USD proceeds for step 4. Okay. What's the first number, guys?
1,014,000.
Exactly, right. So 1.014 million USD. Second number, step 3.
$810,800.
Yes, exactly. And what about step 4? How much do I get in the USD? So I want to take the proceeds from step 3 and I divide it by the forward rate.
1 million.
1 million and
37,000.
1 million.
750. Yeah, 1,037,758.
758. Exactly. Yes, that's correct. Thanks, James. So if I want to find my profit, I'm going to take this number and I'm going to minus it with this number. Okay. So investment returns minus investment costs. So that will be about 23,758 USD. Okay, so I think in terms of this arbitrage calculation, I think it's more intuitive than the cross rate arbitrage that we did before. So hopefully it will be, you guys will find it easier. So we have done question 1 together. For question 2, the trick with question 2 is that you do not have to go back and change everything from the start to the euro. For question 2, you can easily find the answer by just adjusting one single step in whatever we have done before, okay? I mean 2 steps to be exact. So in this case, to answer question 2, you do not have to go back to redo from step 1 to step 5. What you can do is you can tweak step 4 and step 5 a little bit. Okay, I'm just going to call this 4.2 and 5.2. Okay, and how do we do that? So remember with question 2, you want to end up with a profit in the euro, okay? So whatever USD proceeds you have, you want to convert it into the euro.
So we divided by the initial amount we acquired, which is 0.9903.
Where is that? Where is the 0.9903?
In the parity equation.
Okay. You divide which number?
Should be forward rate. Yep. Divided by the actual forward rate.
Not quite what I'm thinking about. Can you elaborate, please?
So you can go ahead.
Okay. Yeah, so think about it. Maybe your approach is right. It's just not what I'm thinking about. So what I'll do is that I'm going to, instead of converting the euro into the USD in this step, I'm going to convert this into the euro in step 4. Okay. So with question 2, instead of having to go back and redo everything using the euro, what you can do is you can convert this USD into the euro using the forward rate. Okay. So with the first transaction, you expect to be paying 1.014 million USD in 3 months' time. So to make sure that you have enough USD to pay in 3 months' time, you want to be computing the euro equivalent of this obligation at the forward rate. Okay. So essentially, what we are saying is that from the euro proceeds that we earn from step 3, we are going to set aside some to pay off the borrowing in step 1. Okay. So the euro equivalent of 1.014 million USD at the forward rate is computed as 1.014 million USD times 0.7813. Okay. And how much would that be? So that will be 792,238 euro. Okay. So in step 4.2, we want to be selling this much of euro forward to settle our loan in step 1. Okay. The euro proceeds, therefore, the euro profit, sorry, in step 5 is going to be the difference between our euro investment return in step 3, so 810,800, and the euro cost of settling the loan. Okay, so you take your investment return, you minus the investment costs in euro, 238, and that will give you the euro profit for this strategy. Okay. Is that clear? So in question 2, if you're not too comfortable with what I did before, with tweaking steps 4 and 5, what you can do is you can go back to redo step 1. Instead of starting with the USD, you can start with the euro. Yeah, and work from there. Okay. But I think this will be more efficient. Let me save the notes and I'll share it with you. Okay, so we have finished the first part of this chapter, which is on interest rate parity conditions. Any questions so far? Okay, so if there's no more questions, let's conclude the class for now. So as I mentioned before, it's a good time to look at the assignment. If you have any questions or concerns about the assignment, I'm happy to go through your questions next week, at the start of next week. Anything else? Besides the assignment, you would also have 2 small quizzes that I will announce during the week that you have the quiz. And other than that, I will see you next week for part 2 of the interest rate parity conditions topic then.
Thank you.
Thanks, James. Thanks, guys. So I'll conclude the class for now. Have a good week and I'll see you next week.
You too. Have a good week.
Bye, James.